Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only, and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Well, the US dollar, which measures the greenback strength against a basket of 6 major currencies, was a little bit weaker overnight as it slipped through the 102 handle and posts a 101.80 closed in New York. This was partly on the back of a GDP figure that came out in the US, which was slightly lower from 2.7 previous to 2.6. Looking ahead, though, the market now awaits the Fed's preferred inflation gauge, which is the Personal Consumption Expenditures Price Index. From there, we could see a little bit more in terms of the numbers, which should provide further clues on how much inflationary pressure remains in the economy. Looking at the Australian dollar, the market still remains fixed on that top side level around 67.35. And I feel like previously we'd be a little bit apprehensive on the challenge because of the fact that the RSI and MACD is still relatively lackluster in terms of showing little strength. As we grind higher, the market's most probably going to find good supply there and maybe an ambush and sending it all the way back from 67.35 back to about 66.5 and reassess, and with the base holding beneath there at 65.90.95. The euro rallied further due to the weaker dollar and now looks towards the level or the challenge of 109.45. Anywhere from 109.45 to 109.90 will be a little bit on the guard in case of a bearish ambush, due to the fact is upon this region was seen as a very firm challenge, but came back in a very negative bias after those 3 heavy days. Could see a similar pattern performing. No, so anyway, beyond 109.45 to 109.90 may find at least supply emerging or profit taking, as we have been rallying since the lows around 105. Although the dollar has weakened, the price action for dollar yen remains relatively firm. Since clearing that key level around 132, the market is now heading closer to its next objective around 134.50.80. I feel in light in terms of the market's pattern that we could see further gains beyond 134.80, and from my recent call still remains somewhere around 138 to around 142 as the broader or primary objective. I like the way these technicals have come back very, very strong in terms of the bullish divergence, the hammer, previously posted from the bottom here, and now dragonfly, and also breaking through the midway point, just waiting for the MACD to marry up to the RSI, and therefore could see that rise. Slightly stronger pattern coming through for sterling as well, as the market takes the challenge higher and looks towards 123.90 to 124.20. A little bit on your guard at these levels due to the fact that when we were here in early 2023, around in January, we saw the market heavily contested, and even back in December 2022, good supply came, and therefore with the technicals a little bit to the lackluster side, and also the MACD is relatively just coasting now. Could see some profit taking as we have come quite a way, or quite a distance, since around that low 118. A slightly further display of strength coming back into gold as the market now looks possibly back towards that level around 1,986 to 90, but towards 2,000 again I feel the market will struggle. Seeing how these technicals are holding relatively weak, I feel that this engulfing candle may pose little threat, and therefore if this pattern continues, then we will see the market snap back to the downside and still with a call down to 1,935. Wrapping up with oil, we can see the market's reached its objective. First of all was around 72.5 and now 74.30.40. Market is still relatively strong. I like the way this pattern is holding, and now almost clearing 74.40. We could see the rise up to 76.45.65 and reassess. Well, that's a wrap for the morning. Thank you very much for joining me. And as always, look out for the intraday report and hope you enjoy the great start to the day.